G'day and welcome to the program. My name's Semple from ANDIKA. Today I'd like to talk to you about the covered combo strategy. So what is it? Well, it's a strategy requiring the simultaneous purchase of the underlying security and the selling of out-of-the-money call and put options representing the same number of shares at different exercise prices but with the same expiry date. And the strategy can also be leveraged. Now, it's important that we get the underlying right. So let's have a look at a graph here of National Australia Bank. Again, we can see here that the price of National Australia Bank is trading above its 50-day average, so it's in an uptrend. So that's an important thing. Now let's actually now put together the actual strategy with some real numbers. So we go and buy 1,000 NAB, we're paying around about $28.44, and the stock has come dividend, and I've assumed around 73 cents. We also then go and sell the NAB JUNE2010 $29 call option, for which we receive 57 cents. We then also sell the NAB JUNE2010 $27 put, for which we receive 55 cents. All up, including the dividend, we're looking at a credit of around about, and being exercised as well, of $2.41, or around about 8.5%. Now the standstill return works out to be about $1.85. What that means is the premium of the call, the put and the dividend based on a purchase price would give us a return of around about 6.5%. However, we could also be put the stock because we have sold a put. Now if that were to happen, the average price on the NAB would now be around about the $26.80 mark. But just remember, if you've bought 1,000 NAB, sold one call, sold one put, and you are assigned on the put, you will now own 2,000 NAB shares. So maybe at that point, if that's the outcome, you probably just want to do covered calls going forward rather than continuously sell more puts. This example all up would require access to around about $54,000 per position. Obviously you need, the startup capital to buy the 1,000 NAB shares outright, but then you need to have at least 27,000 there in case you're assigned on the sold put. So let's just look at some ground rules and all that sort of thing. Now you would execute the covered combo when the underlying stock is trending up, its sector's trending up, and the market is trending up. Hence that's why I wanted to use NAB to illustrate that point. Now it's important you do not enter a written position, i.e. sell a call or sell a put, if there's a reluctance to own the stock. So when in doubt, stay out. Now also do not enter a written position if you're emotionally attached to the stock. This probably more has a rule if you are just doing a covered call over existing shares. The reason being is by selling calls, you are capping your upside. If the underlying share should go up and come expiry, your call is in the money, you will be assigned, you'll have to sell the stock. Some of us might get attached to our stocks, so don't write options over stocks you're attached to. Now, don't also just buy stocks specifically because the current premium levels on the options are really high. Just be mindful, be aware of the reasons for higher than average time value. So that's important there. Don't just get caught up in stocks with high volatility because the premiums are juicy. Sell put options if you are prepared to buy the stock. If you're not prepared to buy the stock and you're selling puts, that's a recipe for disaster. What you then probably would want to do, still sell the put if you like the idea, but then go down a few dollars out of the money and buy a put. In the previous month, we looked at the bull price spread with puts, where we sold a put and bought a put underneath. Well, you could add that extra leg in here if you just want to make sure you cover your downside. Be mindful and be patient that time is your friend. You're selling calls and you're selling puts. So once you put the strategy in play, sure, monitor it in case there's any price decline, but really you just want to let it play out. I generally say sell options within a 3-month time frame. You could obviously sell it within a 1, 2 or even greater than that. I suppose the real point here is when you're selling a call and selling a put, you're going to get a certain premium. You are going to be up for certain trading costs, so you just want to make sure at the end of the day the premium you're receiving is adequate compensation. Where possible, and this is just a general rule, you want to try and sell a little bit on the high volatility when it's around in the market. And obviously if you're buying options, you're buying it in low volatility environments. And lastly, if you're just writing covered calls, just remember, selling covered calls is a risk-reducing strategy. Selling naked call options is a risk-increasing strategy, so that's important. Don't be tempted to say, I don't need to own the underlying, I'll sell some calls, I'll sell some puts, they'll balance each other out. That's just called a strangle trade. In a market that's pretty flat, you might get away with it, but if there should be a spike in volatility, that could either mean the upside could be breached or even the downside, and you can get yourself into a world of hurt. Until next we meet, Good trading.